On July 9, 2025, Bank Negara Malaysia made a pivotal move by cutting the overnight policy rate, or OPR, by 25 basis points to 2.75%. This was the first rate reduction in 5 years, signaling a significant policy shift. The decision came amid global trade tensions, new U.S. tariffs on Malaysian exports, and a slowdown in GDP growth. With inflation stable at around 1.2%, the central bank had room to act without worrying about sparking price hikes. This policy change set the stage for a ripple effect across the financial sector, especially for small and medium-sized enterprises, or SMEs. Reasoning behind the OPR cut was clear. Global trade tensions were mounting, and new tariffs from the U.S. threatened Malaysian exports. At the same time, economic growth was moderating, with GDP growth in the first quarter of 2025 at 4.4%. By lowering the OPR, Bank Negara Malaysia aimed to support domestic demand and ease financing costs for businesses. The stable inflation rate provided the necessary cushion, ensuring that the rate cut would not trigger unwanted price increases. This move was designed to help businesses weather external shocks and maintain momentum. Following the OPR cut, commercial banks like CIMB responded quickly by lowering their lending rates. This immediate transmission meant that financing costs for businesses, especially SMEs, dropped almost overnight. For many, this reduction in borrowing costs provided a much-needed relief. It allowed businesses to reconsider their financial strategies and opened up new possibilities for reinvestment. The banking sector's responsiveness was crucial in ensuring that the benefits of the policy change reached the real economy swiftly. Let's focus on a mid-sized retail chain based in Kuala Lumpur. This SME had a RM500000 variable rate loan at around 4.25%. Like many businesses, it was feeling the pinch of rising interest costs, which limited its ability to reinvest in crucial areas like IT upgrades and cloud optimization. The company was also spending RM15000 per month on cloud services, mostly on on-demand AWS instances. With tight margins, every ringgit counted, and the pressure to optimize costs was mounting. Main challenge for this SME was the rising cost of interest payments. As rates had climbed in previous years, more of the company's cash flow was being directed toward servicing debt. This left less room for reinvestment in technology and cloud optimization, both of which are critical for staying competitive in the retail sector. The company needed a way to break this cycle and free up resources for strategic initiatives that could drive growth. After the OPR cut, the SME's effective loan rate dropped to about 3.9%. This translated into annual savings of roughly RM1200. While the amount may seem modest, it was enough to prompt a strategic rethink. The freed-up liquidity, though small, provided the company with an opportunity to reconsider its spending priorities and look for ways to maximize the impact of every ringgit saved. OPR cut didn't just benefit businesses. Lower borrowing costs also meant that consumers had more disposable income. This boost in consumer spending supported retail demand, creating a more favorable environment for businesses like our featured SME. As customers found it easier to finance purchases, the retail sector saw a positive knock-on effect, further justifying the central bank's decision. The savings from lower financing costs, the SME decided to focus on optimizing its cloud spending. The company's IT team mapped out a plan to redirect the RM1200 annual savings into smarter cloud strategies. The goal was to stretch every ringgit further, reduce monthly cloud costs, and improve overall efficiency. This marked the beginning of a targeted cloud optimization journey. First step was to shift 40% of predictable workloads, such as inventory management and point-of-sale systems, to reserved cloud instances. By committing to these reserve plans, the SME was able to cut costs by about 30% for these workloads. This approach provided cost certainty and helped the company better manage its monthly cloud expenses. For customer-facing applications, the SME retained on-demand cloud instances. This allowed the company to remain flexible and responsive to seasonal demand spikes. By balancing reserved and on-demand resources, the business could optimize costs without sacrificing the ability to scale up quickly when needed. This hybrid approach ensured both efficiency and agility. Further optimize costs, the SME moved its development and testing workloads to spot instances with auto-scaling. This strategy allowed the company to take advantage of lower prices for non-critical workloads, saving up to 70%. Auto-scaling ensured that resources were available when needed, but costs remained under control. This was a smart way to maximize the value of every cloud dollar spent. SME implemented a FinOps dashboard to monitor cloud usage and prevent over-provisioning. This real-time monitoring tool provided visibility in spending patterns and resource utilization. By catching inefficiencies early, the company could make data-driven decisions and avoid unnecessary costs. The dashboard became a key part of the SME's ongoing cloud optimization efforts. Amplify the impact of its savings, the SME applied for the SME Digitalization Grant through SME Corp Malaysia. This matching grant provided an additional RM5000, which when combined with the financing savings, created a reinvestment pool of about RM6200 in the first year. This extra funding accelerated the company's cloud migration and optimization plans, making digital transformation more accessible. By combining the RM1200 and financing savings with the RM5000 grant, the SME created a meaningful pool of resources to invest in cloud optimization. This approach demonstrated how even modest policy-driven savings, when paired with government incentives, can have a significant impact on a company's digital journey. The reinvestment pool enabled the SME to pursue more ambitious IT projects. As a result of these strategic moves, the SME managed to reduce its monthly cloud spend by RM1500. This was a substantial saving, especially for a mid-sized business. The reduction in IT costs freed up additional resources that could be reinvested in other areas, such as marketing, product development, or further digital upgrades. Within just 12 months, the SME saw its return on investment, or ROI, double. The combination of lower financing costs, cloud optimization, and grant funding created a powerful multiplier effect. The company was able to achieve more with less, demonstrating the value of a strategic approach to both finance and technology. With the savings and improved IT infrastructure, the SME expanded its e-commerce platform. This move resulted in an 18% year-on-year increase in online sales. The company was able to reach new customers and diversify its revenue streams, making it more resilient to external shocks like export tariffs. By focusing on domestic online sales, the SME improved its resilience against tariff-driven export slowdowns. The shift to e-commerce allowed the company to offset losses from international markets and maintain steady growth. This strategic pivot was made possible by the liquidity boost from the OPR cut and the company's commitment to digital transformation. This case highlights a key takeaway. Even modest policy changes like a small OPR cut can create valuable liquidity for SMEs. When businesses are proactive, they can turn these opportunities into meaningful reinvestment and growth. The link between policy and business outcomes is clear and direct. When SMEs redirect financing relief into cloud optimization, the results are measurable and impactful. This synergy between financial strategy and technology investment is a blueprint for sustainable growth. It shows how businesses can leverage every advantage to stay ahead in a competitive market. Pairing savings from policy-driven financing relief with government grants accelerates digitalization for SMEs. This combination not only amplifies the impact of each ringgit saved, but also helps businesses achieve their digital goals faster. It's a powerful example of how public and private sector collaboration can drive transformation. Banks, fintech lenders, and cloud providers all have a role to play as enablers of SME resilience. By offering financing, digital tools, and strategic support, these partners help businesses navigate uncertainty and seize new opportunities. The ecosystem approach ensures that SMEs are not alone on their digital journey. Summary: the July 2025 OPR cut gave SMEs a small but strategic liquidity boost. By combining financing relief with cloud optimization and government grants, one retailer turned a RM1200 annual saving into a RM1500 monthly reduction in IT costs and an 18% increase in online sales. This case demonstrates the power of aligning policy, finance, and technology for sustainable business growth.